Investing can be a great way to grow your wealth, but it can also be intimidating if you don't know where to start. I'll be covering the basics of investing and providing some easy to understand examples to help you get started. I'm Vineet. Welcome back to my channel and let's begin. So, why should you invest? Well, that's simple. By investing your money, you have the opportunity to earn a higher return that you would normally get with your traditional savings account. Over time, this can help you reach your financial goals, such as retirement, buying a home, or paying for your children's education. The goal of investing is to make your money work for you and grow over time. But it is also important to understand the concept of risk versus return first before going further. When you invest your money, you're taking on a risk in the hopes of earning a return. Generally speaking, the higher the risk you take on, the higher the potential return you can earn. Conversely, the lower the risk, the lower the potential return. Let me give you an example. Let's say you have $1,000 to invest and you have two options. Number one, you can invest in either a low risk savings account that pays about 1% interest per year, or you can invest it in a high risk stock that has the potential to earn 10% returns per year. If you invested in a low risk savings account, you are unlikely to lose your money, but you'll also earn a relatively low return. In this case, your $1,000 of investment would earn $10 per year in interest. On the other hand, if you invested in a high risk stock, you have the potential to earn a much higher return, but you also run the risk of losing some or all of your money if the stock price goes down. For example, if the stock price goes down by 20%, your $1,000 of investment would now be worth $800. Overall, the key is to find a balance between risk and return that is appropriate for your individual investment goals and risk tolerance. It is also important to do your research, diversify your investments, and have a long-term investment strategy in place. Okay, now let's go back to investing. There are many different types of investments, including stocks, bonds, real estate, and more. In this video, I'm mainly going to talk about investing in the stock market. So what are stocks? Stocks are shares of ownership in a company. When you buy a stock, you become a part owner of that company. If the company does well, the value of your stock may increase, allowing you to sell it for a profit. However, if the company performs poorly, the value of your stock may decrease. When it comes to investing in stocks, it is important to understand the level of risk involved. The value of stocks can fluctuate based on a variety of factors, including company performance, market conditions, and global events. However, investing in stocks can also offer the potential of high returns. One way to start investing in stocks is by researching companies that you believe will perform well in the future. This can include looking at a company's financial statements, analyzing industry trends, and considering any upcoming product launches or any other events that may impact the company's performance. Once you have identified a few companies that you are interested in, you can purchase shares of their stock through a brokerage account. Some popular brokerage platforms include Robinhood, Fidelity, or Freetrade and Trading 212 here in the UK. I personally use Freetrade and Trading 212 in the UK. Both of these offer commission-free trading. You can sign up to these using my referral link in the description below. When purchasing stocks, it's important to keep a few things in mind. First, you'll want to consider the price of the stock. Stock with a lower price may be more affordable, but they can also be riskier. On the other hand, stocks with a higher price may be more stable, but they may also offer a lower potential return. You'll also want to consider the company's market capitalization. This is the measure of the company's size and can give you an idea of how well established the company is. Large cap companies with a market capitalization of 10 billion or more are typically more stable and less risky, while small cap companies with a market capitalization of less than 2 billion can be riskier but offer a higher potential return. Finally, you'll want to consider the company's dividend yield. But what is a dividend? Dividends are a way for companies to share their profits with the shareholders. When a company earns a profit, it can choose to keep the money for itself, to reinvest in the business, or to pay off debts. Or it can distribute some of the profits to its shareholders in the form of dividends. Dividends are completely at the discretion of the company, and it is not a compulsory requirement at all to give dividends. When companies do choose to pay dividends, they are typically paid out on a regular basis, such as quarterly or annually, and they are usually paid out as a certain amount per share. For example, if a company pays out a dividend of 50 cents per share and you own 100 shares of the company's stock, you would receive a total of $50 in dividends. Dividends are often considered a way to earn steady stream of income from your investments, particularly for investors who are seeking a source of passive income in their retirement. However, not all companies pay dividends, and some companies may choose to reduce or eliminate their dividends if they are experiencing financial difficulties. Overall, dividends can be a way to earn a return on your investment, but it's important to remember that dividend payments can fluctuate and are not guaranteed at all. Okay, now you know what a dividend is. The dividend yield is the percentage of the stock's price that the company pays out in dividends each year. Now, let's take a look at the example of investing in stocks. Let's say you're interested in investing in technology companies. After doing some research, you identify 3 companies that you believe will perform well in the future: Apple, Google, and Microsoft. You decide to purchase shares of each company's stock through your brokerage account. You purchase 10 shares of Apple at $160 per share, 10 shares of Google at $100 per share, and 5 shares of Microsoft at $280 per share. This brings your total investment to $4,000. Over the next few months, the stock market experiences some volatility due to global events. However, the companies you have invested in continue to perform well. Apple announces a new product launch, Google reports strong earnings, and Microsoft signs a new partnership agreement. As a result, the value of your stocks increases. After about 6 months or so, the value of your Apple stock has increased to $180 per share, your Google stock has increased to $130 per share, and your Microsoft stock has increased to $300. You decide to sell your shares of Apple and Microsoft, earning a profit of $200 and $100 respectively. You decide to hold on to your shares of Google, which you believe will continue to perform well in the future. So basically, in this example, you are able to earn a profit by investing in stocks. However, it is important to remember that investing in stocks does come with its own risks, and it's important to do your research and make informed investment decisions. Now, you must be thinking that investing in stocks is a lot of hard work. You'll have to do a lot of careful research, analyze fancy charts and graphs, and then invest. That too with having a high risk tolerance, and there is still a high probability that you may lose your money. The question arises then, is there an easier way to invest where I don't have to do that much research, which is less risky, and what if someone else is doing the research for me? Would that be amazing? Well, this is where investing in funds comes in, and that's the next topic I will talk about. I don't want to keep this video too long, so I will make another video to talk about investing in funds. Please stay tuned for more helpful personal finance content, and consider liking this video and subscribing to my channel. Also, please share your thoughts in the comments below. Thanks for watching, and I will see you in the next one.